Welcome everyone to this event jointly organised between the Law Society and the British Chambers of Commerce here in Brussels to discuss cross-border EU-UK trade and particularly VAT and the new landscape that we see with VAT. Now, there have been some significant changes to the VAT regimes over the last month or so as a result of Brexit, but also as a result of new changes that have come in the UK in terms of smallish value consignments into the UK. And there are changes, of course, coming on the EU side later this year as well. So we've got a lot to talk about today. From the industry side, I can say we have some significant concerns, particularly with the changes in the UK on some of the VAT consignments there. But also there are significant challenges for businesses that are moving goods now in terms of VAT that they have to pay whenever goods are going across the borders between the UK and the EU. It's a new landscape, and hopefully we've got some experts here who are going to be able to make it much less complicated for everyone. And we have three experts on the panel who are going to speak to us today. We've got David Pruden from HMRC, who is going to give us an overview of the changes to the VAT regime and import VAT for physical shipments. Then we've got Edward Brett, who's also from HMRC, who will talk specifically about the new rules on consignments that are under £135, particularly for online marketplaces and e-commerce. And then we have Martin Shah from Simmons and Simmons, who will talk to us about the VAT changes from the EU side and the impact that will have on services. And then after that, we have a Q&A session. And feel free to ask any questions. Now, because of the platform that we have, if you have a question, please put it into the chat function, and I will then ask those questions to our panelists. So please, if you have any questions, please put them in chat. I will promise you that I will do my best to get through all the questions. But I think with no further ado, I will pass the floor to our first speaker, who is David Pruden for HMRC, and he, like all the speakers, will speak for about 10 minutes. So David, over to you.
Thank you very much. Yes, so I'll say a little bit about exports. So if you can go to the next slide, please. So yeah, I'd say a little bit about exports. There's not too much to say, but then the focus after that is mainly on imports of goods. Well, because I have a bespoke VAT accounting, and then I'll hand over towards the end of those bullets that you see or that you previously saw. So I'll hand over to Ed at that point. I'll be talking mainly about VAT registered businesses. So this is mainly in the context of VAT registered businesses. There'll be the odd reference, I think, with what both Ed and I say, which do touch on consumers or non-VAT registered businesses. So yeah, so the first page, from 1st of January 2021, the essentials: that movements of goods from Great Britain to the EU are now exports. Movements of goods from Northern Ireland to the EU continue to be dispatches. So that means for goods moving from Northern Ireland to the EU, previous inter-community rules will remain for business to business, so VAT registered business to VAT registered business supplies, and they'll be zero rated as dispatches. That's a specific excise point: Northern Ireland to EU business to consumer, so that's B2C, which is business to consumer, or business to non-VAT registered business. Supplies of excise goods do require the seller to register for VAT in the place of consumption with no threshold, and the movement of the goods is a deemed supply of the transfer of own goods in those circumstances. But the last bullet is the general position. For exports from GB to the EU, goods will be zero rated, whether or not they're excise goods. So next slide, please. So imports and acquisitions, so it's the other side of the coin. Movements of goods from the EU to GB are imports and no longer acquisitions. If you're VAT registered, import VAT, not acquisition VAT, will be due. acquisition VAT will continue to be due on goods moved from the EU to Northern Ireland. So postponed VAT accounting is available to UK VAT registered traders who import goods into GB from anywhere outside the UK, or if they import goods into Northern Ireland from outside the UK and the EU. And postponed VAT accounting allows importers to account for and recover import VAT on the same VAT return. So it's broadly similar to the existing acquisitions process on each EU to GB, which applied before the 1st of January. Other existing means of paying import VAT remain available, so by duty deferment or immediate payment, and non-VAT registered traders will pay VAT when they make their customs declaration using or continuing to use one of those existing means of payment. Different rules apply to goods excluding excise and consignments valued at £135 or less, which Ed will come on to cover later. So next slide, please. So on that, postponed VAT accounting, so PVA is selected on the customs declaration, and the trader's EORI, if you're using Chief, or VAT registration number, if you're using CDS, is entered. That generates an online monthly statement, which the trader then will be able to access and download, and will need to download as it contains the information the trader needs to complete their VAT return, and it's actually only going to be available to download for 6 months, so you need to make sure it's downloaded in that time. Traders don't need to be authorised to use PVA, but you do need to subscribe to CDS to access the online monthly postponed import VAT statement. I think there's a little bit more about that later on. So to use postponed VAT accounting, the imported goods must be for use in the trader's business. I'll say a little bit more about that later on. Non-established taxable persons, they are entitled to use PVA, but the general position for NETPs is that in order to import goods into the UK, they need to hold a UK EORI and instruct an agent to make the customs declaration on their behalf. So next slide, please. And a couple of other circumstances where PVA is available. It can be used when imported goods are removed into free circulation from a customs special procedure, so typically customs warehouse. And it can be used when imported excise goods are released for home consumption, and that does include when goods are released from an excise warehouse having been in duty suspense into the point of import. Now, the use of postponed VAT accounting is normally optional. However, if you use staged customs controls and you import non-controlled goods into GB from the EU in the first 6 months of 2021, then you have to use PVA and account for import VAT on your VAT return. And that is if you use the EIDR process. So if you make a declaration in your own records, and generally that may be where you wish to delay the customs declaration, which is the key thing that stage customs control is about. But it also applies, you're still mandated to use PVA even if you don't actually delay the declaration if you make an EIDR. So next slide, please. So if you use someone to import goods on your behalf, so if you get a personal business to import goods on behalf, and that can be freight forwarder, customs agent, broker, fast parcel operator, then you need to tell them how you want to account for import VAT on those imports so they can complete the customs declaration. And if you already have someone, you should contact them to tell them if you want to use PVA so that you can account for VAT on the VAT return, and you need to keep a written record of what is agreed. I would add that if you're using Royal Mail Group do not have the facilities to provide PVA, so you will need to check the provisions that RMG use, but they don't offer PVA on goods over 135. So I said I talked a bit about business and non-business. So PVA is essentially allowed in where at all possible. So you're able to use PVA to account for import VAT on your VAT return if you import goods which are going to be used either both for business and non-business purposes, or if you don't know actually what purpose they're going to be used at the point that you import them. The only circumstances where you can't use PVA is if you import goods and you know they are solely going to be used for non-business purposes, so you can't put that on your VAT return, and it means you'll need to select a different method of payment when you make your customs declaration. And a bit about completing the VAT return yourself. So the import VAT is included in box 1 of the VAT return. You can reclaim it subject to the normal input tax rules in box 4 of your VAT return. And the monthly statement, the import VAT statement gives you all the information that you need to do that. If you do use delayed supplementary declarations, it's a bit more fiddly, because you're not actually going to have your statement available when you complete your VAT return, because the statement's only produced when you make your supplementary declaration. So in those cases, you need to make an estimate initially, and then when you do get your delayed declaration, then you will need to make an adjustment if you need to on the following VAT return. Bear in mind, if you're a fully taxable business, then the import VAT will be fully reclaimable as import tax in any case. And then a bit about accessing the PVA statement. So you do need to access CDS to view and download your PVA statement. That's true whether or not you use Chief or CDS to make the declaration. It's simply the mechanism for accessing your statement requires you to sign up for CDS, even if it's solely for the purposes of accessing the statement. So some people may have access to CDS, and this just describes briefly how you go about that. The rest of the slide, it's a fairly simple process to sign up for CDS, but you need to do it in order to get your first PVA statements, and it will be only probably the next week the first PVA statements will be generated covering imports made during January. So it's something that needs to be done now. It's tricky for VAT groups. This is the way that CDS works for VAT groups, and just the general process with regard to EORIs. But it means that each member of a VAT group that import goods will have their own EORI, and will need to sign up for CDS to access this statement. And then the representative group member will have to collate their statements in order to complete the VAT return. That is a more cumbersome process than previously existed with the C79s. And at that point, I've come to the end of my main session. So I will hand over to Ed to pick up the consignments values at 135 and over. So over to you. Thank you.
Thanks, David. Good afternoon, everyone. My name's Ed Brett. I'm going to talk to you for the next few minutes about the changes to VAT treatment of overseas goods for those consignments with a value of less than £135, which came into effect from 1st January. So we essentially introduced new rules at the end of transition period, of which there are 2 strands, which changed the way VAT is collected on sales of goods. Firstly, it's, and I'll talk about both, but firstly, it's goods sold to UK customers where the goods are located outside the UK at the point of sale, and the supply involves the importation into UK. And the second section, which is goods sold to UK customers where goods are in the UK at the point of sale, they're sold by an overseas seller, and an online marketplace facilitates the sale. There are some slight differences between Great Britain and Northern Ireland, and I will touch upon those as we go through. The intention has been to sort of essentially keep the look and feel the same, although the actual route sometimes is slightly different. So I'll start with the first point, which is goods sold to UK customers where the goods are located overseas at the point of sale and it is imported into the UK. So from the end of the transition period, I say consignments of value of less than £135 that are outside the UK and sold directly to customers in Great Britain will have UK VAT charged at the point of sale, and are outside the UK and EU and sold directly to customers in Northern Ireland, import VAT will be charged at the point of sale. Both will be accounted for on a UK VAT return. There won't be any sort of collection at the border for either of those processes. The £135 limit applies to the total value of the total consignment, not individual items within it. As well as these changes to goods valued less than £135, we've also abolished low value consignment relief, or LVCR, which relieved import VAT on consignments of goods below £15. Online marketplaces, where they are involved in facilitating the sale, will be responsible for collecting and accounting for the VAT to HMRC. But for goods sent from overseas and sold directly to UK consumers without an online marketplace involvement, the overseas seller is required to register and account for the VAT to HMRC. And I will touch upon at the end of this how to go about registering for VAT, because some businesses won't need to re-register if they're already registered, but I'll come on to that in a bit. So sort of in relation to sort of the second point I mentioned, which is goods sold to UK customers where the goods are already in the UK at the point of sale, but they're sold by an overseas seller and an online marketplace facilitates the sale. I should apologise, this is quite a wordy explanation. There's some links to the guidance at the end, which will perhaps sort of explain it a bit more clearly and give you a bit more of a chance to look through it and sort of understand it. I just sort of really wanted to make sure when I sort of explained it to you today that we got the sort of definitions exactly right, so you're sort of really clear on what these sort of treatments are and when VAT is charged and by whom. So sorry for the sort of slightly wordy explanations there. But so in relation to this second part, where the goods are in the UK at the point of sale, we are moving the responsibility for accounting for the VAT from the overseas seller to the online marketplace that facilitates the sale. In this instance, there is no upper limit to that, so the 135 limit does not apply, and actually it's goods of any value which are captured by this measure. There is a slight difference here in how this works in Northern Ireland, where goods are sold by overseas sellers and held in Northern Ireland and fulfilled or delivered to a Northern Ireland address. The online marketplace is not liable in that instance, and the overseas seller remains liable to account for the VAT. Existing joint and several liability still continues to apply for the online marketplace, but this was simply just reflection of how the EU VAT rules will apply in this instance. And actually, I think Martin's going to talk a bit about the e-commerce changes which are coming into effect in July in the EU, and that should sort of correct this sort of anomaly here. So the final thing, I just forgot I need to move slides, sorry about that. So the final thing I just want to talk about here is about business-to-business sales. So where goods are outside the UK at the point of sale and the supplies to UK VAT registered business, this is still covered by the new arrangements. However, where the UK VAT registered business provides the online marketplace or a direct seller with its VAT registration number, the responsibility to account for the VAT will switch to the UK business. So in those instances, the online marketplace or direct seller is not liable to account for the VAT in those circumstances. If the business recipient is not VAT registered or does not provide a VAT registration number at the point of sale, then the seller or the online marketplace should treat that as a business consumer or B2C sale and account for the VAT accordingly. Just want to say there's no obligation for marketplaces or sellers to actively verify the customer is in business and should by default treat the sale as a business consumer sale unless the UK company provides its valid VAT registration number. So whilst these arrangements that I've sort of set out here today will mean that for most consignments not exceeding £135, there will no longer be any VAT to collect at the border. Customs declarations are still required for non-fiscal purposes. But in recognition of the change role, we have introduced a number of facilitations, including the use of reduced data sets, and bulk declarations are available for parcel operators as well. So the final thing I just want to touch upon, and I don't think there's a slide for that, but apologies for that. But in the guidance, which is is contained within the slides, there is instructions on how to do about this. It's just about registering for VAT in the UK. There's a slide. Sorry. So the main point is for EU businesses, if you're already registered for VAT in the UK under distinct selling rules, you won't need to register again. That existing VAT registration number is fine, and you can continue to use that, and you continue to account for that in the way that you via VAT return. However, if you're not already registered, you will need to register. Distinct selling thresholds for EU businesses no longer apply, so there's no registration threshold, and you'll need to register for VAT for any value of any sales that become liable for VAT under these new measures. Also, obviously the sort of general businesses that will need to register for VAT are online marketplaces that facilitate sales of goods to UK customers, and any business that sells goods directly to UK customers, where the goods are outside the UK at the point of sale, and the consignments are not exceeding £135 in value. And just the last book there, so businesses established in the UK selling goods to UK customers where the goods are already in the UK as at the point of sale should already be registered under existing rules. That concludes presentation. So next slide just sort of sets out some of the links to the guidance on the UK government's website, particularly within the import goods not exceeding £135. There is instructions on and links to where you go to register for VAT as well. Thanks very much. I'll hand you back to Marcus now, I think.
Thank you for that. I'll just take over here and go now to Martin Shah from Simmons and Simmons to speak about the EU side VAT changes. Martin, Great. Over to you.
Thanks a lot, Dan, and good morning, good afternoon to everyone on the line. So I've been asked to cover a couple of items today. One, looking at effectively the counterpoint to what's just been discussed by the colleagues from HMRC in relation to the EU perspective on goods which are coming from GB into the EU. And for these purposes, I'm going to focus on the position for Great Britain rather than getting into the detail of Northern Ireland. And then secondly, I'm also going to take a few minutes just to talk about the impact of the changes in relation to services. And I can see that from the chat, we've maybe got a couple of questions already in relation to that. So first of all, in relation to GBEU supplies of goods, what is the position? Well, from the EU perspective, Great Britain has now become a third country. And so the starting position is that for goods which enter the EU from Great Britain, that the goods in question are going to be subject to import VAT, obviously potentially duties in addition, and that rate which will be charged, the rate of VAT will be charged, will be the rate which is applicable to the goods in question in the member state of import. And so there is an additional set of issues that need to be thought about where goods are moving from GB into the EU to ensure that the necessary VAT is calculated and appropriately applied in relation to those supplies. Thinking about a few practical considerations in relation to GB to EU supplies. First of all, it's important to understand who's the person in the supply chain who's going to be taking responsibility for the VAT duties, and that will depend upon the terms of export/import. So if the transfer of the delivery is being made on a duty paid basis under the Incoterms, so DDP, the effect of that is that the supplier will be responsible, the GB supplier will be responsible for any customs and VAT obligations in relation to the movement of goods into the EU. And that can be contrasted with a situation where the goods are treated as delivered at place from the port where the goods are moving into the EU, where generally the customer will be dealing with the VAT compliance obligations. And certainly we've seen in practice for a number of GB suppliers that they've thought about moving to a DDP basis in order to ensure that they deal with the relevant obligations and they're not creating additional compliance in the EU member state of receipt for their customers, to try and make the process as simple and straightforward as possible. Where goods are being cleared on that basis, we've also seen suppliers thinking about the possibility of VAT registration in the member state of import and whether or not that might provide some benefit to them. And there are a couple of related issues that need to be thought about. So first of all, from a cash flow perspective, am I obliged to pay duty at the border, VAT rather, at the border at the point of import? or is something similar to the PVA system that that had been discussed earlier in the UK context by David. Is something similar to that going to be available in the relevant member state of import? Or equally, might there be, if not a full postponed accounting regime, some ability to defer the point in time when the VAT needs to be accounted for? Now, this is something where suppliers, GB suppliers, will need to look at the individual member state concerned, and not all member states have a suitable regime. So if we look at the Netherlands, Belgium, for example, they tend to have quite favourable regimes where postponed accounting is possible. But you know, if we look at other jurisdictions like Germany, it's only available in a much more limited basis, or for certain member states, not available at all. And so this is something that suppliers will need to think about when considering their supply chains and considering where goods should enter the EU following the changes that came into effect with the end of the transition period. Alongside that, it's also necessary to think about the position regarding fiscal representatives. So for a GB business which is taking on VAT liabilities in the relevant member state, potentially where they are looking to try and make use of postponed accounting or a VAT deferral regime, in many cases there will be a requirement to appoint a local fiscal representative who will effectively face off against the local tax authorities and will be responsible for dealing with compliance obligations. So that's something where, you know, I think in potentially 19 of the 27 member states, some degree of local fiscal representative is required, and that will be something that businesses should have got to grips with, or should be getting to grips with, in terms of what the practical considerations are associated with supplying goods from GB to the EU. Just as has been mentioned in the UK discussion by HMRC, we no longer have the situation where a UK supplier could have supplied goods to consumers in a member state and taken advantage of the distance selling thresholds to effectively avoid VAT being due in the member state of the customer, and instead charging UK VAT on the relevant supply. So those have been removed, which will obviously increase the compliance burden for relevant GB suppliers. But as has been touched on already by Ed in his section, we have got some forthcoming changes for B2C, which are, you know, effectively bringing in within the EU 27 reforms, which are very similar to those which have taken place in the UK already from the 1st of January. And these are going to be really quite sweeping reforms to the VAT obligations for B2C e-commerce sellers in GB, and also marketplaces which are facing those customers. Originally, these were also going to come into effect on the 1st of January, but as a result of COVID, the implementation of these changes has been delayed until the 1st of July this year. And so we do have, to some extent, as Ed has already pointed out, a different analysis in the UK, in GB, compared to the situation that we currently see within the EU 27. In terms of what the reforms cover, that probably is an entire session in itself, just to provide a flavour of the three major elements. First of all, the intention is that there will be a single EU VAT return which will be possible for e-commerce distance sales. So instead of the current situation where potentially a GB supplier is going to have to register for VAT purposes in every member state where they make supplies, instead it will be possible to pick a member state and then account through a single VAT return for all of the supplies which are being made to consumers in any of the 27 member states. And that will greatly simplify compliance measures, both for GB suppliers, equally for US and other non-EU suppliers who currently have significant compliance obligations where they are providing services from a non-EU jurisdiction to consumers within the EU. So that's going to significantly simplify some of the compliance measures, but it's not there yet, and businesses will need to be getting to grips with the current rules for that 6-month or now 5-month period until these new rules come into effect. Alongside that change, there's going to be a removal of the EU equivalent of the low-value consignment relief, so the current VAT exemption for small parcels coming into the EU, which are valued at less than €22, where I think there has been a perception that that's been open to abuse through the appropriate values not being declared, and therefore import VAT not applying on those supplies of parcels coming into the EU. And so instead, what's going to happen, as I say, very similar to the position now in the UK, is that for shipments below €150, VAT is going to be generally charged at the point of sale by the supplier, and they're going to have to account for that VAT to the relevant tax authority, obviously with the possibility of the one-stop shop being available to facilitate compliance. The third of the changes, which is going to be very significant, is the change to the position of marketplaces. So the marketplace will effectively become the deemed supplier, and so there the responsibility may pass from a supplier to the marketplace itself to charge, collect and account for VAT at the appropriate rate by reference to the member state the customer is in. And what we might see there is that where potentially non-EU, including GB suppliers, have maybe had registrations in a number of states, the marketplace may take on some of these obligations from July, and that may actually allow the sort of real supplier, for want of a better word, to deregister for VAT purposes, because that compliance will pass across to the marketplace. Obviously, as Ed has touched on, these rules are generally applicable where the goods in question sit outside the EU, and so it's going to be important to understand whenever it comes to implementation of these changes where the goods sit, or are we actually still within a situation where the current rules apply, because the goods are already within a member state and are going to be fulfilled from that member state, in which case the current rules will broadly continue to apply. That's all I was going to say in relation to GB to EU goods. But as I said, I was also going to pick up the position in relation to services. So unlike the position in relation to goods, where both suppliers and customers are having to grapple with quite a few changes, actually the changes on the services side are fairly limited. And the key considerations remain, first of all, establishing whether the supply is a business-to-business supply or a business-to-consumer supply. And secondly, linked to that, where is the place of supply for VAT purposes? In relation to business services, generally the position is and remains that the supply is treated as being where the customer is resident. So if I have a situation where I've got a UK supplier of B2B services to an EU customer, an EU business customer, that's going to be outside the scope of UK VAT, because the supply is treated as taking place in the customer's member state. And then in the member state, it will be the responsibility of the business customer to self-account for VAT under the reverse charge mechanism through their VAT return, and obviously that reverse charge VAT being recovered or not, depending upon the VAT recovery position of the customer. So that largely as you were, and the equivalent position will apply where we've got services being imported by UK businesses from EU business suppliers. And typically the starting position, the general position, is that that will be outside the scope of EU VAT in the relevant member state, but with reverse charge UK VAT applying and being accounted for by the UK business customer through the VAT return and being recovered or not, depending on the VAT recovery position of the UK business customer. In relation to business consumer services, the position there is different. So we start with the general position that the service is treated as supplied where the supplier is resident. So historically, currently, a UK supplier of business to consumer services would charge UK VAT on their supplies to EU and indeed non-EU customers. But there are certain special rules which apply for certain types of services. So it's worth bearing those in mind, because for these B2C services, they fall outside the general rule of the supply being where the supplier is resident, and instead typically will be treated as supplied where the customer is resident. What are the relevant suppliers? Well, there's quite a long list of these, but just picking out a couple of situations. First of all, in relation to digital services, those are generally treated as supplied where the customer is resident. UK businesses making cross-border digital supplies of services may have made use of the mini one-stop shop in the UK and accounted for VAT to HMRC. they will now need to change. So they will now need to register in an appropriate member state and report EU B2C digital service sales under the non-union mini one-stop shop, or alternatively, they would need to think about registration in each member state where they're making supplies. So that is a compliance step which will need to be taken by relevant UK businesses. And on the flip side, as I think has already been touched on, EU businesses with UK customers, consumer customers, will need to register for VAT in relation to their supplies of digital services coming into the UK. For sports and cultural events, generally that's located in the country of the event, and post July 2021, we should be able to treat that as falling within the one-stop shop. And then finally, the rather long list of services covering things like legal, accounting, financial services, professional services more generally. And there again, the position has changed. So previously, pre-January, where it was a UK supply to an EU consumer, UK VAT was charged, but now the EU is treated as a third country for UK purposes. And so if I've got, let's say, a supply of legal services from a UK law firm to an EU consumer, that will now not be subject to UK VAT. And so for relevant suppliers, they'll need to be thinking about their systems and ensuring that they deal with the change in liability of those services from being subject to UK VAT to now falling outside the scope of UK VAT. Conscious of time and the fact that we've got quite a few questions, so I think Dan, if I maybe hand back to you